Perfect. Hello, everybody. Tony Alvarez from Keller Williams Hoover here, and I'm today again with my good friend Danny Gagliano from Gagliano Mortgage. How you doing, Dan? Andy? What I say, Danny? I'm
That's
thinking too
okay.
many things.
That's all right. That's all right. I'm well. How are you?
I'm doing great, doing great.
Good.
Enjoying this beautiful weather that we have here in Alabama.
Yes,
Cold in the morning, warm in the afternoon, and cold again at night. So
that's right. Yeah. Well, it's a sign that seasons are changing, so it won't be long before it's hot all the time.
exactly, exactly. We're supposed to have an early spring coming, so I'm looking forward to enjoy the spring weather. It's one of my favorite seasons.
Yeah.
Second favorite, my first favorite is on the fall, so
Yeah.
looking forward to that.
Yes, indeed. I understand.
Well, Andy, I was talking to a few people this weekend, and they wanna try to understand if there's certain amount of income they need to make a year to qualify for a mortgage. I was trying to explain to them that it's not necessarily income wise. I mean, although there is certain products for investors, I believe that they can use the income of the property they buy if they're investing. But for a person who's buying the personal residence to buying a home, they're going to live in it. The best way to see for how much they qualify or if they qualify for a mortgage is using what we call the debt income ratio, the DTI, right?
That's correct.
Can you
Yeah.
more or less give us an idea or explain what that it is, what that means, and how it
Yeah.
works?
Yeah. I'll be glad to. So, the debt to income ratio is very simply put the amount of debt someone has in relation to the amount of income that they have. And so, what underwriters like to see is that someone's debts on a monthly basis are no more than 45% of what their gross monthly income is. So, the before tax monthly income. So, that's something a lot of people look at and say, well, I make this much money after tax. That's my bring home pay, but that's not what we look at. So, we look at the before tax number, and then there are some debts that we're not going to take into account, such as auto insurance, goodness, cell phone bills, utilities, those types of debts we do not take into account, but we do take into account some debts, any debt that's going to show in someone's credit report. So student loans, credit card debt, of course, any other mortgage payments that they may have, child support, alimony, those are debts that we have to factor in as well. So what we typically do, and I'm going to keep this example very simple because I don't want to get too complicated with the math because my feeble little mind can't handle too much of that. So if we take somebody's combined gross monthly household income, and let's say it comes in exactly at $10,000 a month combined. So we can take up to 45% of that income to go towards all debts. So that would be 45% of $10,000 would be $4,500. It
Yeah.
can go towards all debt. Now that's going to be the proposed new house payment plus those other debts. So if somebody has two car payments that total $1,000, well, now we've just taken that $4,500 figure down to $3,500. And then if they have four credit cards where the minimum monthly payments on those credit cards are $1,000, now we've gone from a total of 4,500, take out the cars, we're at 3,500, take out the credit cards, we're at 2,500. And if they have $500 a month in student loans, that comes off. And now we're looking at $2,000 a month that we could use towards their mortgage payment. So
Okay.
just, I'm going to give you an old car salesman trick.
Mhm.
And so I learned this years ago when I actually was on a car lot looking to buy a new truck. And the salesman came up and I said, hey, I'm looking at new trucks, but I want to keep my payment, you know, let's say just $400 a
Uh-huh.
month. And the car salesman said, well, you'd be looking at roughly $20 a month payment for every $1,000 that you borrow. So if you want to keep your payment at $400 a month, you want a car note of no more than 20 grand. So I thought, when I heard that, I thought, you know what? I can use that for my business. So that's a good, kind of a good rule of thumb. So what we're looking at today is about $8.75 per $1,000 borrowed to go towards someone's house payment. So if they wanted to or they wanted to get a $200,000 mortgage, you would simply take the 3 zeros off the end. You'd end up with 200, multiply that times 8.75, and that would be, help me out, $1,750 for a monthly payment?
Somewhere around there,
Okay.
exactly.
So somewhere in that ballpark, 1750, and that's going to be based on today's interest rates, with property taxes, with homeowners insurance, and with mortgage insurance added into
So
that payment.
roughly, it's a good example because I mean, let's say 1,700 a month. That's almost a rent payment in some places.
Oh,
You
yeah.
know, or it's
Yeah,
a couple $100 more than probably the current rent that some people is paying. But the
absolutely.
big difference is that you are paying and building equity on your home, on something that is belongs to you. You're not building equity to somebody else.
That's
And
right.
not only that, you also your interest rate, it is tax deductible, correct?
Your interest can be tax deductible depending on what income is, what your total deductions are, and that kind of thing. So yes,
Okay.
that is something that could help someone pay less income tax.
Yeah, definitely. But the most important thing it is that what you're paying in your rent today in some places here in the Birmingham area. I've seen some houses, 4 bedrooms, 3 bathroom homes with a rent payment of, well, we're talking about 2,500, 2,700 a month.
Oh, yeah.
It's a lot of money. It's a big difference. So if you can qualify for a mortgage, I always tell people, and I'm always going to be telling everybody, don't focus on the interest rate. Focus on what your payment is going to be and if you can afford it.
Yeah,
If you can afford that monthly payment, then go ahead, make the purchase. But if you're not going to be able to afford it, if you're not sure that you can make those payments, then guess what? Don't risk it. Don't buy the house. Don't listen to anybody else.
that's right.
If your financial are not good and you're not good yet to pay the mortgage, but still you need to talk to a mortgage expert like Andy so that we can guide you when you can buy that house. If it not happen today, it can happen in 6 months, in a year. We can revisit, we can review all the process again. That's not a problem. The most important thing is that you take the first step and apply for a mortgage. You don't qualify right now, you're going to qualify soon if you follow certain steps and the guidance of the experts, right?
That's right. Yeah.
Perfect. That's one of the things that I tell everybody, and they always ask me how much I need to make to buy a house. I always tell them, well, it's a variances. So, and the right now just answer that question. It's different factors that um, gonna show you how much you can afford and how much your payment can be. And it's
Yeah.
always good. Don't live with a doubt. Am I going to be able to pay? Am I going to be able? I'm not sure. I think my credit is not good. A lot of people use Karma Credit. I think believe it is
Yeah.
something
Credit
like that.
Karma. Yeah.
Credit Karma.
Yeah.
How accurate do you think that is?
Ooh, not very accurate. And the reason is that the credit scores that Credit Karma provides are actually different scoring models than what we use in the mortgage industry. So typically, if someone comes to us and they say, well, my credit score is 740 according to Credit Karma, then I'm gonna say, okay, that means that their mortgage credit score is probably going to be in the 7 to 710, maybe 720 range. Typically, the mortgage credit scores are going to come in a little bit lower than the scores that you're going to be provided by a service like Credit Karma or Experian or someplace, some service like that.
Yeah, correct. Okay. Like I say, it's always good to have an expert on your side. It's always good to talk to the people who live and work this business on a daily basis. And that is people like Andy, that is people like myself, that we see, well, we haven't seen everything in the business yet.
That's right.
But we have seen a lot. And if we don't have the answer right away, rest assured, we're going to get that answer for you as soon as we can.
That is very true. And, I think it's important to stress to people that it's not my job to turn loans down. So I want to work with someone. If they can't get approved today, then I want to work with them and say, hey, here's your game plan. Here are the 3 action items that you need to take over the next month, 3 months, 12 months in order to be able to buy. And so these conversations, I'm not going to say that they won't be emotionally painless, but we try to make them that way. We give you, if we have to give you bad news today, I want to give you something to look forward to down the line. And most of the time, it's not that far down the line before you can get that good news and become a homeowner. So
that's correct. This is not a definitely no. It's a not yet,
right.
not right now. So
That's
let's
right.
work it out. Let's make a plan and let's make it happen. So if you guys want to hear more about it, you guys have more questions about mortgages and real estate, just give us a call. I'm Tony Alvarez from Keller Williams. My phone number is 205-370-3248. Andy?
And I'm Andy Gagliano with Gagliano Mortgage, and my number is 205-979-4412, and I'm at extension 1.
All right, folks, that's what we got for this week, and we hope we see you again next week. Thank you, Andy, again for being
Thank
with
you,
us
Tony.
today, and
I appreciate it.
see you next week.
Sounds like a plan. Have a great week.
You too.
All right. Goodbye.